Good day, class. In today's lecture, we will be taking a look at financial institutions, in particular, the central bank and the commercial bank. Just to review the objectives of today's lecture, we'll be taking a look at what is the central bank, what are the functions of the central bank, what is a commercial bank, what are the functions of the commercial bank. We'll also be taking a look at credit creation, instruments of monetary policy, as well as the impact of monetary policy on an economy. Now, on to slide 3. What is a central bank? A central bank is a bank that forms part of the financial institution or the financial system. The central bank is the apex of the financial system. It is responsible for ensuring the smooth working of the banking sector and the other financial institutions. The financial bank's main aim is to work closely with the government and to operate in the public's interest. Examples of central bank includes the Central Bank of Trinidad and Tobago, the Federal Reserve, the Central Bank of Barbados, the Eastern Caribbean Central Bank, which governs the OECS countries. We are moving on to slide 4. On slide 4, we are going to be examining what are the functions of a central bank. So we know what a central bank is. We know that it forms the apex of the financial institution. We know it's the main bank. It's the mother bank. It works hand in hand with the government to ensure the welfare of its citizens. What are the functions of the central bank? We can see listed on the slides the main functions of a central bank. The central bank is the government's bank. The central bank is the banker's bank. The central bank holds the nation's gold and foreign currency reserve. The central bank manages the country's exchange equalization account. It issues notes and coins. The central bank implements monetary policy. The central bank is a lender of last resort. And the central bank ensures financial stability. In the next few slides, we are going to examine each function in detail. So we are moving on to slide 5. The first function of the central bank is that the central bank is the government's bank. In this role, the central bank looks after the finances of the central government. And for this purpose, the central bank would hold the government balances, which is known as public deposits. The government's income from taxes, trading activities, and privatization proceeds is also paid into the account that is managed by the central bank. Out of this account, the government also pays for all of its expenditure on social services such as health and education. So the central bank is said to be the government bank. All government finances is stored and managed by the central bank, and all of government's expenditure comes from an account that is governed and managed by the central bank. So the central bank is the government's bank. Next function of the central bank is the banker's bank. It holds bankers' deposits with the clearing bank used for the following purposes. And when we talk about the banker's bank, the commercial bank's bank is the central bank. So it holds deposits to settle debts with each other, to pay monies to the government, to receive monies from the government, and to exchange old and worn out notes and coins for new ones. So the central bank is said to be the commercial bank's or other banks' bank. Another function of the central bank is that the central bank holds the nation's gold and foreign exchange reserve and also manages its exchange equalization account. Now, the exchange equalization account is the account that holds the country's gold and foreign currency reserve. The bank uses these reserves to intervene in the foreign exchange market to influence the exchange rate between their currency and other currencies. And the central bank is the one who manages that account, which controls and helps influence the exchange rate, and which controls and holds all the nation's gold and foreign currency reserves. So that is managed by the central bank. Another function of the central bank is that the central bank is responsible for issuing notes and coin. The central bank is said to have a monopoly in issuing notes and coin, although some commercial banks may issue their own notes and coin, which has to be backed on a one-on-one basis by the central bank notes. The bank is also responsible on behalf of the government to issue new coins and issue new notes. In Trinidad and Tobago, during the 50th anniversary, the central bank with the government released the $50 bill, right? Now, the only person or the only institution that can do that is the central bank. Right? So the central bank is responsible for issuing new notes and coins into the economy. Another function of the central bank is this, and the most important function of the central bank is that of the implementation of monetary policy. This is the most important function of the central bank. Now, the central bank level of efficiency is dependent on how effectively they are to create and administer monetary policy, and the bank has to carry out these objectives with in line with the government. What is monetary policy? Monetary policy is concerned with controlling the annual growth of the money supply. So the central bank is responsible for implementing monetary policy, which deals with controlling the money supply. Too much money in an economy is dangerous. Why? Because too much money drives inflation. Too little money in the economy is also not good. Why? Because it makes the economy stagnant and there's going to be little economic growth. So the central bank is responsible for managing monetary or implementing monetary policy to ensure the right balance in terms of the money supply in the economy. Another function of the central bank is the central bank is said to be a lender of last resort. And the central bank is the ultimate source of cash. That is, a cash shortage in a country can only be relieved by the central bank. Now, cash shortages are usually felt by commercial banks when the movement of funds to public deposits is not compensated by an equivalent reserve movement of funds to bankers' deposits. Cash shortages are usually relieved by the central bank unless the central bank wants to see the rise in short-term interest rates. So when there's a cash shortage, the central bank is the one of the responsibility of alleviating that shortage. The commercial bank can also relieve their shortage by borrowing from other banks, which is called intercommercial bank lending. Right? So whenever there's a shortage in the economy, the central bank is the one who's able to alleviate that, unless the commercial banks decide that they want to take a loan from another bank, which is called intercommercial bank lending. The central bank is also responsible for financial stability. We are on to slide 11. The bank is responsible for ensuring the overall stability of the financial system, and they put in place and implement many policies that are responsible for monitoring, limiting, and detecting risk in the financial sector. So the bank is the one responsible for the oversight of the financial institution or the financial sector or the financial system to limit, monitor, and detect any risk to that sector. So far, what have we seen? What are the functions of a central bank? Central bank is the lender of last resort. They're responsible for issuing notes and coin. They ensure financial stability. They implement monetary policy. They issue notes and coin. They manage your country's exchange equalization account. They are the banker's bank, and they are also the government's bank. Now, what's about commercial banks? What are commercial banks? Commercial banks, on to slide 13, commercial banks are deposit-taking institutions. They make profits by lending at a higher rate of interest than the rate they pay on deposits. So commercial banks usually pay a low interest rate or no interest at all. They offer a wide range of services such as loans, foreign exchange, as well as insurance and pension products. Now, the functions of the commercial bank is very different from the functions of the central bank. The commercial bank has four main functions. 1, credit creation. 2, transmission of money. 3, advisory services. 4, provision of financial products. Let us take a look at each function of the commercial bank. So the first and most important function of the commercial bank is that of credit creation. And this is the process by which banks are able to increase the volume of credit by granting loans. The process results in an increase in the volume of bank deposits and hence in the money supply. Now, an important principle of credit creation is to have an effective clearing system. What is this? This is a process by which banks settle claims and counterclaims between themselves. This means that there must be some system of clearing checks. So I'm sure many times you've gone to the bank and they tell you that a check must take 2 or 3 days to clear. This basically means that they have to reconcile which the one person's account and debit another person's account to ensure that the person who you receive the check from, that they actually have money in that account, and they have to draw down on that account in order for your account to be credited. So that is called a clearing system. Right? So credit creation is a process by which the commercial bank is able to increase the volume of credit. And in order for us to have credit creation, we must have an effective clearing system or a clearing house. Another function of the commercial bank is that of money transmission. And the transmission of money is important because it deals with customers transmitting money from one source to another. And customers with current account may write checks to pay their creditors. Banks offer other methods of money transmission, such as standing orders, direct deposits, direct debits, credit cards, checking accounts. All of these are forms of making payments and transmitting money. Banks also issue debit cards, which debits their user's account. Traveler's check is also another form of transmitting money. So all the different products that that the commercial bank offers to transmit money is all part of the function of money transmission. Another function of the commercial bank is that of advisory services. Banks usually charge for these advisory services, and some of these advisory services include trusteeship, foreign exchange, broking services, investment management, and taxation. Right? So these are just some of the advising services that are provided by commercial bank. And the last function of a commercial bank is that they offer financial products. And I'm sure you can think about many financial products that are offered by a commercial bank. And this include mortgages, insurance, and all the other things that you go to a bank to do. Right? So these are called financial products. You might offer car loans, housing loans, loans for school, vacation loans, carnival loans. All of these are examples of financial products as well as investment packages. Right? So far we have seen that there's a distinction between the commercial bank and the central bank. The commercial bank deals with everyday citizens. The central bank deals with banks and financial institutions. We don't have any business with the central bank, but the financial institutions have business with the central bank because the central bank governs the financial institutions. Right? Now, through the central bank, the government is able to, or the central bank is able to control the money supply. Remember, I said the money supply is the amount of money in an economy. Too much money in an economy is dangerous, and too little money in an economy is also dangerous. So we are moving on to slide 19, where we are going to examine some types of monetary policies. Remember, the most important function of a central bank is that of the implementation of monetary policy. So slide 19 highlights for us some key monetary policies that can be implemented to control the money supply. And this includes open market operation, interest rate policy, special deposit, lending ceilings, funding, request, and changing the cash reserve ratio. We are now going to move on to examine each type of monetary policy in detail. So the first type of monetary policy that can be implemented is that of the open market operation. What is open market operation? This refers to the sale and purchase of government securities on the open market by the central bank. So if the central bank wishes to reduce the money supply, it will sell securities on the open market. The buyer will pay for these securities with check drawn from the account with commercial banks. Now the central bank who now holds this check will debit the account of the commercial bank with itself. This falls into the banker's deposit. This fall in the banker's deposit will represent a fall in the commercial bank cash reserve. The bank will now reduce its deposit liability by calling its advances to its customers or refusing to give advances. So basically, if there's too much money in an economy, the central bank will sell bonds on the open market. Whoever is buying these bonds, the central bank is taking money away from them. It's not only taking away money from these individuals, but it's taking away money from the commercial bank, because these individuals would have been saving in the commercial bank. So when you buy these bonds from the central bank is taking away money from the economy, therefore reducing the money supply. In the same way, if there's too little money in the economy, the central bank would do what? The central bank will buy bonds from the public. By buying bonds from the public, it means that they will have to pay for these bonds, which means they would be injecting money into the economy, therefore increasing the money supply. Another policy that can be implemented to control the money supply is that of interest rate policy. And changes in the rate of interest at which the central bank provides liquidity to the banking system are often linked with open market operations. So if the central bank wishes to reduce the stock of money or the supply of money, it will sell securities on the open market. And the central bank may force the desired increase in the interest rate. Now, this will result in the rise in the cost of borrowing and may depress the demand for loanable funds. Right? In the same way, if the central bank wishes to reduce the interest rate, it will buy securities. So you want to increase the interest rate, you sell securities on the market. The central bank wants to increase the money supply, you would buy securities on the open market. Right? Another policy is that of special deposits, and the central bank may have the power to require banks to lodge with them what is called a special deposit. And call for special deposits are usually expressed as a uniform percentage of each bank total eligible liabilities. So the central bank may require a certain percentage of the commercial bank's liabilities to be lodged with the central bank. What does that do? That cuts down the amount or reduces the commercial bank's liquid assets, hence reducing the bank's ability to create credit or to give credit. So if the central bank is saying, guess what, commercial banks must put a certain percentage of their liabilities in the central bank. What does that do? That reduces the amount of money the commercial bank have to make available to the public through loans. And that is a way in which you can reduce the money supply. Another monetary policy is that of lending ceilings, and a central bank can lay down certain quantitative limits on the growth of bank assets. So this also restricts competition as they hamper efficient banks who are in the position of creating new deposits. So that's putting a lending ceiling, which is a cap or maximum that banks are able to lend. So that is helping to reduce the money supply. Another type of monetary policy is that of funding, and this is where the central bank attempts to lengthen the maturity of outstanding government debt. So if the central bank sells longer dated securities, this reduces the commercial bank cash reserves. So you are lengthening the payback period on government securities, which means it lessens the cash reserves of the commercial bank, right? Therefore, reducing the money supply. Another measure that can be implemented, or another type of monetary policy that can be implemented, is that of request. And this is where from time to time, the central bank may ask or request the commercial bank to change the lending into or away from a particular area. So for example, the central bank may say, make it easier for farmers to get loans, right? Or make it difficult for farmers to get loan. So you are requesting that the commercial banks either change their lending into an area or remove it from an area. Therefore, in cases making it easier for certain classes of people to get loans and or sectors, people in different sectors, and sometimes making it more difficult. And this is called request. And the last type of another type of monetary policy that can be used is that of changing the cash reserve ratio. And this is where the central bank can change the minimum cash reserve ratio to control the money supply. And this will reduce the credit multiplier. So this is where they may increase the amount that a commercial bank should have in cash reserves. So if you increase the amount the commercial bank should hold in cash reserves, then it means that the commercial bank would have less money to make available to the public, therefore reducing the money supply. Right now, all of these measures are sometimes aimed at reducing or increasing the money supply to ensure the right balance within the economy. So that these are known as monetary policy. These are monetary instruments used to control the supply of money within an economy. Right now, other sources of change in the money supply could be government expenditure, financed by borrowing from the central bank, government borrowings from the banking system, a change in the public desired cash holding, a change in the bank's demand for required reserve, and the balance of payment disequilibrium. So these are just other sources that would change or affect the money supply in the economy, right? But the central bank is the one who governs monetary policy, and all policy geared towards controlling the money supply is known as monetary policy. Therefore, we can see that there's a distinction between the commercial bank and the central bank. And the central bank has a main aim of implementing monetary policy to control the money supply in any economy, whereas the commercial bank main aim is to create credit and to provide investment and advisory services to the public as well as to transmit money. I do hope that this lecture would have given you a much clearer indication or much clearer understanding about the role and functions of the central bank in Trinidad and Tobago and commercial banks within our economy. I do hope that you enjoyed this lecture. Have a blessed day, and remember, if you have any questions, queries, or concerns, please do not hesitate to reach out and let me know. Post me a question in the questions and answer, send me an email, or meet me during office hours. Have a blessed and wonderful day.